Welcome to the world where financial freedom isn't just a dream, it's an achievable goal. Imagine waking up every day knowing your money is working hard for you, even when you're taking it easy. Sounds pretty good, right? That's what we're here to explore, turning your financial dreams into reality. In this guide, we'll unlock the secrets of the Rule of 72, a magic key to doubling your money. But we won't stop there. We're diving deep into investment strategies, sharing real-life success stories, and revealing how to keep growing your wealth over the long haul. Think of this as your roadmap to building a future where you're in charge of your finances, not the other way around. Ever heard the saying, "The best time to plant a tree was 20 years ago. The second best time is now"? That's exactly how it feels about investing. Whether you're just starting out or looking to up your investment game, it's never too late to make smart moves that can change your financial future. So, are you ready to discover how simple numbers can lead to big wins in the investment world? Let's get started on this journey together. By the end, you'll not only have a solid grasp of how to double your money, but also how to make it grow and flourish for years to come. Buckle up, it's going to be an exciting ride. Chapter 1: Introduction to Wealth Building. When we talk about building wealth, it's not just about stacking cash in a safe. It's about creating a future where your money works for you, not the other way around. Sounds dreamy, right? But here's the catch. The path to financial freedom is filled with myths, misconceptions, and outright misinformation. That's where we step in, armed with the Rule of 72, a simple yet powerful formula that's about to become your best friend. Imagine doubling your money without the high-stakes gamble of day trading or the slow crawl of traditional savings accounts. The Rule of 72 is your shortcut through the financial jungle, a compass pointing towards smarter investment choices. It's been a secret weapon for investors for decades, yet it's as straightforward as high school math. Did you know that Albert Einstein reportedly called compound interest the eighth wonder of the world, and he attributed his own financial success to it? While the authenticity of this quote is debated, it highlights the magic of compounding, where your interest earns interest, setting off a chain reaction of growing wealth. But why 72, you ask? It's the number that, due to the wonders of mathematical simplicity, easily divides by many interest rates, providing a quick and dirty estimation of how long it'll take for your investment to double. Whether you're eyeing stocks, bonds, or real estate, the Rule of 72 doesn't discriminate, offering clarity and confidence in your investment decisions. Chapter 2: Understanding the Rule of 72. Let's get down to brass tacks. The Rule of 72 states that if you divide 72 by your investment's annual rate of return, the quotient is the approximate number of years it'll take for your initial investment to double. So if your investment has an annual interest rate of 9%, just divide 72 by 9. The answer, 8, is how many years it'll take for your money to double. Simple, right? This rule shines in its ability to make investment decisions more approachable. Instead of getting lost in complex financial forecasts or the anxiety-inducing fluctuations of the stock market, the Rule of 72 offers a beacon of simplicity. It transforms the abstract into the tangible, turning someday into a calculable future date. Moreover, this rule is a testament to the power of compound interest. The beauty of compounding lies in its ability to accelerate wealth creation as your investments generate earnings, which in turn generate their own earnings. It's like planting a tree and watching it bear fruit, which then plants more trees. Interestingly, the Rule of 72 can also serve as a cautionary tale against the erosive effects of high inflation on savings. In an era where inflation rates can soar, understanding how quickly your purchasing power could halve is just as crucial as knowing how fast your investments can grow. To bring this concept home, let's consider a real-world application. If you're a young entrepreneur eyeing a startup investment with a potential 12% annual return, the Rule of 72 tells you that your investment could double in just 6 years. This kind of insight is invaluable, whether you're planning your retirement or strategizing your next business move. Chapter 3: Application of the Rule of 72 in Investment Strategies. Now that we're cozy with the Rule of 72, how do we put this secret weapon to use in our investment arsenal? This chapter is all about action, taking that knowledge and turning it into a game plan for your financial future. First off, let's talk diversification. It's like not putting all your eggs in one basket, because if that basket falls, well, you know the rest. By spreading your investments across different asset classes, stocks, bonds, real estate, you're not just minimizing risk, you're setting multiple wealth doubling timers simultaneously. Using the rule of 72, you can gauge which baskets have the potential to double your money faster, adjusting your strategy as you go. But it's not just about speed, it's about endurance. Consider a retirement fund. With a modest annual return of 6%, your investment will double every 12 years. If you start in your 20s, that's a potential for your money to double multiple times over before you retire. This illustrates the power of starting early and the magic of compounding over time, a strategy that can turn modest savings into a substantial nest egg. Here's where it gets even more interesting. Technology investments have become the golden children of high returns, but they come with their fair share of volatility. Say you're drawn to the tech sector's potential for a 14% annual return. The rule of 72 suggests your investment could double in just over 5 years. However, remember, with high reward comes high risk. Balancing high-growth investments with more stable, lower-return options is key to a well-rounded portfolio. Let's not forget about the impact of inflation. Imagine inflation rates are at 3%. Using the rule of 72, you can predict that the purchasing power of your money could have in about 24 years. This insight is crucial for retirees or anyone planning for long-term financial security, emphasizing the importance of choosing investments that outpace inflation. Chapter 4. Beyond Doubling. Compounding for Long-Term Growth. By now you're familiar with the rule of 72 and how it can guide you in doubling your money. But let's not stop there. True financial freedom comes from understanding and harnessing the power of compounding over the long term. It's about playing the long game, where patience and consistency turn into your greatest allies. Consider the concept of compounding interest as the snowball effect. You start with a small snowball, your initial investment, and as you roll it down the hill, over time, it picks up more snow, interest, getting exponentially larger. The longer it rolls, the bigger it grows without you having to push harder. This is the essence of long-term growth, allowing time and the natural momentum of your investments to build your wealth. But how do you maximize this effect? It starts with reinvesting your earnings. Instead of taking out the interest you earn, you reinvest it, adding to your initial investment. This may seem like a small difference at first, but over decades, this choice can be the difference between a comfortable retirement and a lavish one. Let's bring in some numbers for perspective. If you invest $10,000 at an 8% annual return in 9 years, thanks to the rule of 72, you'd have about $20,000. But if you let it compound for 30 years, not just 9, you're not looking at just double or triple, but over $100,000 from your initial $10,000 investment. That's the power of long-term compounding. Moreover, strategic reinvestment isn't just for individual stocks or bonds. This principle applies to dividends from stocks, interest from bonds, or even rental income from real estate investments. By continuously reinvesting your earnings, you're effectively employing your money to make more money, capitalizing on the exponential potential of compound growth. Chapter 5. Getting started with your investment plan. Feeling inspired and ready to take action? Perfect. Let's talk about creating your personalized investment plan. Remember, the most successful investment strategies are those that are well thought out, tailored to your financial situation, and most importantly, started early. First step, define your financial goals. Are you saving for retirement, a new home, or your child's education? Your goals will dictate your investment strategy, including how aggressively you should invest and what types of investments you should consider. Next, assess your risk tolerance. Not everyone is comfortable with high-risk investments, even if they offer the potential for higher returns. It's essential to know your comfort level with risk and potential losses, as this will guide your choice of investments. A diversified portfolio can help manage risk, combining higher-risk investments with safer ones to achieve a balanced approach. Now educate yourself on the options available. From stocks and bonds to mutual funds, ETFs, and real estate, the investment world is vast. Each type of investment comes with its own set of risks and rewards, and understanding these is key to making informed decisions. Don't forget to plan for taxes and inflation. These can eat into your returns, so consider tax-efficient investments and strategies to mitigate the impact of inflation on your purchasing power over time. Lastly, consider seeking professional advice. A financial advisor can offer personalized advice tailored to your financial situation and goals. They can help you navigate the complexities of investing, tax planning, and estate planning, ensuring that your investment plan aligns with your overall financial strategy.